Brian Grimes, your real estate mentor, back with another action-packed session. On tonight's live, we're going to talk about how to create big tax losses with rental properties. These are those massive tax losses, as much as $500,000 off of just one property. I'm going to show you guys a strategy that is a little bit more achievable for you guys if you're just getting started. So you can do this with like smaller rental properties and scale your way up. So make sure you stick around, ask lots of questions. If you're new to the channel, like, comment, subscribe, leave a comment that says I subscribe, share the content with someone who you want to get value. If you're interested in any of our mentorship programs, we have our Boots on the Ground program. That is our full service done for you program where we find, finance, rehab, tenant, and manage properties for you. We do that in the Philadelphia area. Just reach out, DM me, Boots on the Ground. If you're interested in our ride along tour, we have another tour coming up Saturday, November 15th. So that's coming up in just a month now. We're already sold out through like half of the tickets. So if you're interested in that, just reach out, DM me, ride along, drop a comment that says ride along, and we'll send you information about that. And it's basically a tour. You can spend a day with me touring properties. You'll get access to course content, and you'll learn the game. And if you just want to tap into any of our mentorship knowledge, like what it took me literally like millions of dollars to learn and trials and tribulations through this game, you can go to that link right there, 247cashflowtraining.com/university. You can test out our training portal and get access to our group coaching for just $1. It's $1. You can test it out and then see if you want to be a part of it. But we'll give you access to all different types of relationships, private money lenders, kind of the whole nine. So it will help you to scale. So guys, once again, if you have questions, drop them in the chat, drop them in the comment section. I'm just going to flow through this, and then we are going to shift to another call, inner circle call around 9. So how to create big tax losses with rental properties. I think from a mindset standpoint, what you need to know about real estate in general is there are 3 ways that you're getting paid. Actually, there's 4 ways that you're getting paid. 3 main ones, and then a 4th, which is kind of ancillary. But with real estate investing, you're getting paid in these 3 ways. One, and this is what everybody thinks about, is cash flow. So you get a property and you hold it as a rental. Let's say the mortgage is $900 a month. The rent is $1,500 a month. You're getting some cash flow, right? This is money you can put in your pocket. And a lot of people think about real estate just at that. Like, hey, I want to get some rental properties. I want to build up a stream of income so that I can get out of the 9 to 5. And that will work. If you just built a plan to, acquire one property, maybe 2 properties a year for the next 5 to 10 years, you would be out of the 9 to 5. It's really that simple. You can scale your way out step by step. The second way you get paid is through appreciation. So as you hold on to a rental property, it tends to increase in value. So over something that you bought for, $100,000, $150,000 in markets like Philadelphia, where you can still, do that. You can buy a property for $80K. It's going to be worth $250, $350. It's going to start appreciating. I had a property in South Jersey that I purchased for $75,000, bank owned, that 3x'd in value in about 7 years. When I let it go, it was worth like $220. Now it's worth $350. So it's maybe, what's that, like a 4x, 5x, 7x? Yeah, to get the 335 off of 7, it's like a 7x return or something like that, 5x, something like that. So you can get good returns there. Then you get tax losses. We're here to talk about taxes because you're only promised two things in life: death and taxes. So you're going to die at some point, and you're going to pay a lot of taxes before then. So this is how savvy investors don't pay taxes. There are a lot of flippers out there. They pay taxes. There are a lot of people doing other strategies out there. They pay a lot of taxes. They tend to not talk about taxes at all because they don't want to stack up against like our core strategy and what we do. But this is going to show you how to avoid the tax man completely. It's 100% legal. The U.S. tax code was written for landowners and business owners. So as you start to understand this information, you'll realize that, hey, this real estate, this rental property game has a bit more to it than I realized. Maybe I'm looking at this thing all wrong and putting too much pressure on a property's ability to cash flow or its appreciation potential. So you are going to get tax losses. We're going to talk about how you can get, somewhere between I would say 30 to 60,000 in tax losses, even on a regular like Philadelphia row home, basically. So I'll walk you guys through that process. And then a property will pay you in debt pay down. So as that tenant is paying the mortgage, they're paying down the debt over the course of time. So that's building up more equity. So we're going to run through cost segregation, bonus depreciation, and then a 500K loss, what it would take to generate that degree of a loss. So stick around, ask lots of questions. If you're getting value, like, comment, subscribe, share the content with someone who you want to get value. So cost segregation is pretty straightforward, right? With cost segregation, here's how it works. If you take your typical residential property, this works differently for commercial properties, but there are similar principles. You can still do this on a commercial property. They are just depreciated differently than a residential property. So this is like, what you would buy on Redfin, the MLS, a single family, a duplex, a triplex, or a quadplex. These properties are depreciated on a straight line 27.5-year basis. That means if you bought the property for, we're just using like big numbers. If you had a property and you had a taxable basis of 100,000, you would divide that by 27.5, and then you can deduct that number, approximately $3,000 per year, on your taxes as a paper loss. It will be just a depreciation, what we would call like ghost depreciation loss. So 27.5 years is the traditional way to depreciate your assets over this duration of time. Just 1 year after the next, 3,000 a year, and it'll stack up to your tax basis. When you get into cost seg, this is something where you would hire a CPA firm that specializes in this. Your regular accountant might say they can do this, but if it's not their specialty, you really don't want them doing it. This is kind of pseudo legal / CPA type of work. Like it's a bit of a mixture of both. When you rope them in, what they're going to do is a analysis. So they're going to take the same property that was receiving 27.5-year straight line depreciation, and they're going to break it up into sections. So instead of having one asset, they're going to take, the roof, that's going to have like a 15-year span. Then maybe the windows, those are 7 years. Those are only going to be good for X amount of time. The flooring, the kitchen cabinets, the carpet, that's going to be 5 years. And they're going to break this asset up into these different line items, and then you can accelerate the depreciation. So instead of taking the flooring or the doors or maybe the trim or the carpet and depreciating it over 27.5 years, you're now going to depreciate it over 5 years. So you can think about that logically. If you bought a carpet, or if you installed a carpet in your rental property and that cost you $5,000, not saying it would, but if it did, and you could depreciate that over 5 years, that's $1,000 a year that you can accelerate that depreciation into. For 27.5 years, I mean, you'd be lucky to get $250 a year. So this can make a tremendous difference. And when you do this across a portfolio, this is how people are generating, massive tax losses in the hundreds of thousands. And I've taken advantage of this too. So I know it works, and it's something that you absolutely have to factor into your plan if you want to scale, because saving money on taxes, getting money back in the form of refunds, is going to give you more capital to go further in this game. Guys, if you're getting value, like, comment, subscribe, leave a comment that says I subscribe, share the content with someone who you want to get value. If you're interested in any of our programs, once again, we have Boots on the Ground, where we will find, finance, rehab, tenant, and manage properties for you. Just reach out, DM me, text me, email me, Boots on the Ground. And then we have our ride along tour coming up Saturday, November 15th. For all the skeptics, if you want to come out and see, is this real? Let me see what's going on here. You can come out and just see the operation, see a bunch of properties in different phases of full gut rehab, learn the cost of construction hands-on, get course content, get your 24/7 cash flow hoodie, and network with other investors from across the country who are tapped in, who are getting deals done. I actually just had, there were 2 people in the last month that recently tapped into Boots on the Ground. I was just talking to one guy today, and he's only been in the program 3 weeks. He's already got a deal or 2. Another one has 2. So people are definitely coming in and getting some quick results. It's starting to like pick up faster than ever, I would say. So definitely tap in if you're looking to get a deal done, especially if you want to get something done before year end. And then you can always go to that link. If you want to just tap into the course content, you can do a $1 trial for a week and check out the course content, tap into some of the coaching calls. We'll put together a custom game plan for you to try to help you to get started, even if you're starting with like limited liquidity, limited cash, credit, those types of things. Reach out, just tap into that link. I dropped a link in the chat as well. $1 trial. Check it out and see if it's for you. It'll definitely help. And it's essentially the same program that people will pay $5,000-$10,000 to get access to. So it'll give you a lot of access. Bonus depreciation. Let's get into this. So bonus depreciation works in conjunction with cost segregation. So the first step is to do a cost seg study, to hire an accountant that specializes in this. That may run you anywhere from, I'll call it $800 to maybe $5,000. I mean, it shouldn't really cost more than that. You can certainly shop it around, and we can give you some referrals if you need them. But it's essentially, bonus depreciation is an IRS rule. This actually got refreshed from the big beautiful bill. So with these bills, there are things you're going to hate, things you're going to maybe like. As a real estate investor, this is probably one of the things that you like about it. But what it allows you to do is accelerate your depreciation. They recently refreshed this up to 100%. It was starting to get phased out. So having this, we'll call it this group in office has helped in that sense, because it got refreshed, and it's something that really helps a lot of investors out. When you combine accelerated depreciation with cost segregation, what it'll allow you to do is go a little bit further than even these parameters. So when you use them in conjunction, you can typically get about a 30 to 40% loss on the value of the building within year one. So using these together is what allows you to get these massive losses. So 30 or 40%. For my Philly people who are in boots on the ground or from Philly or kind of investing in markets like Philly, Baltimore, Delaware, Jersey, you can go out and get a property for $225,000 worth of value. You might only pay $80K to buy it and put $80K into the rehab, but 30 to 40% of that $200,000 of property value, this is how you can get $30, $40, $50, $60,000 of losses on just one rental property. So it's something that you absolutely have to do. Many of you, because I talked to you, you have properties and you haven't done this yet. And there is a catch-up clause where if you haven't done this yet and you have existing rental properties, you can do a catch-up cost seg study and then accelerate that depreciation like this year. You can pretty much choose the year. Assuming you filed taxes on your LLC in past years, you can now do this study and then take that complete loss, maybe over the course of like 3 or 4 years, in year one, like this year. You can choose the year. So if you're having a bad tax year, maybe you made a bunch of money or you had a good year financially, and you're looking for a way to shield yourself from taxes, this could be a plan. You need to go look at your rental properties. You need to talk to your accountant. Hey, have we done anything like this? And then get those studies done. You have plenty of time to do it right now. The only key to remember is the property must be placed in service. In service means that technically it could be rented. It doesn't mean that it has to be like move-in ready and passed all inspections and kind of all these things. Just that it is in good enough condition from the rehab that you've done to list it for rent so people can come look at it. Once you list it, it's technically placed in service. Don't try to game the system and list something that you're full gut rehabbing and it doesn't even have any flooring or anything. But once you get the drywall up in the flooring, the drywall doesn't really have to be painted yet. It technically can be lived in even with unpainted drywall. So you can start to list that property in service. This becomes important if you're trying to acquire a property right now, which many of you can still do. Buy a property, October 31st or even November 30th, and try to rehab it quickly, get it listed so that you can bonus depreciate it in this year, 2025. So just make sure your properties are placed in service so that you can get this type of stuff done. Guys, if you're getting value, like, comment, subscribe, leave a comment that says I subscribe, share the content with someone who you want to get value. We're about to get into that 500K loss strategy, kind of what it would take. So I'll walk you guys through that. If you're interested in any of our programs, boots on the ground, you need help with us just doing full service, finding deals for you, handling the rehab, handling the property management, handling the tenanting, so that you can do this turnkey. And we have people in that program from all over the country, outside of the country, who are tapped in and collecting rental income now. Many people have done multiple deals, 6, 10 deals, definitely a handful, 2, 3 deals for most people. So if you need help scaling, just reach out about boots on the ground. And that's our full service program. And then if you want to tap into the course content and really just learn the game, or you're working with a tight budget, maybe limited cash and credit, tap into that link, www.247cashflowtraining.com/university. Tap into that $1 free trial while we have that, because we don't keep any of these specials, but tap into that, test it out for a week. If you like it, stick with it and get the help you need. This is the same level of mentorship people pay $5,000-$10,000 for. So you'll take it or you won't. Let's get into this 500K loss strategy. So this is something that the average person could do, and that I'm seeing regular, run-of-the-mill, everyday people do through programs like our Boots on the Ground program. You could also do this buying turnkey rentals, or there are many ways to do this. But let's say you had $50,000 in the right strategy, where you could recycle your capital into multiple properties. What you would do is go out and try to acquire as many rentals as possible. But let's say, like I have, a bunch of clients like this. You go out in a year, you acquire 7 rental properties. Maybe your goal was 10, you didn't quite hit it, but you got 7 properties. I can think of maybe 5 to 10 people that I personally helped to get to this level, and many who've exceeded it. Each property is worth about $200K. That's a $1.4 million portfolio that you're controlling. You don't need a ton of cash to control a portfolio like this. You could take 3.5% and go out and get a $500,000 multifamily and pull out, $25K. So don't make these numbers bigger than they need to be, because there's a lot of leverage in real estate. Let's say out of that 1.4 million, 200K of that is just land value. The land value is usually going to be substantially less than the property value, than the building value that's on top of that land. So 200K, that's land. Land is non-depreciable. You can't depreciate or bonus depreciate land. So that just gets taken out of the equation from your tax basis. Okay. So then you will have a building or multiple buildings, multiple rental properties worth around 1.2 million. Your cost segregation, because you can get this property broken down into shorter term line items. Some must remain, like your brick walls, your foundation walls. If you re-brick the property up, you can't bonus depreciate those bricks. Those bricks have a lifespan of 80 years. So they're always going to be 27 and a half. But a lot of these different line items are going to become items that you can depreciate quickly. They're called short life items. So out of 1.2 million, we'll assume 800K of that is a short life item. Okay. Which means we could bonus depreciate it. Bonus depreciation, it's been refreshed, so it's up to 100%. But let's say you had like bonus depreciation of around 60%, which some are at through different phase downs. That means off of a portfolio like this, 7 rental properties, if you went out and did this, you could generate in year 1 about a 480K tax loss off of this many properties, if you properly bonus depreciated them and had the right level of depreciation in terms of like phase out amounts, 100% versus 80%, 60%. This is a massive strategy, guys. This is why I would say most real estate investors get wealthy. They don't all get wealthy because they're amazing investors and they just hit home runs on every deal, and they're lucky or any of that, or they have the secret deal machine where they're getting all the off market deals and they have this secret that nobody else. It doesn't work like that. The investors that get wealthy, they stick with it. One, they don't quit. So many people quit. You wouldn't believe. So many people quit right at the point of getting started. They might tap in, get started. 2 weeks in, they're ready to quit. Like they just can't stick with anything but the 9 to 5. The same people that will do the 9 to 5 for 20, 30 years, they can't do 2 weeks in real estate because it's not immediate gratification. It's not enough. They're used to working 2 weeks, get a check. Okay, that's my work. In real estate and anything that's commission based or kind of free flowing, there's something called a 2-month delay. The 2-month delay means you will see the results of the work that you're putting in today 2 months from now. You're not going to see it tomorrow. You're not going to see it in a week. And when you understand that delay, you stop checking for it. You stop doing what they call watching the scoreboard, watching the clock. Hey, did I drop 20 points yet? Let's look at the scoreboard. Let me see the stat sheets. The game's still going on. If you want to drop 20, you got to take more shots. That's the only way to score 20 points. In like a basketball game, it's the only way to score a touchdown. Like you have to take more shots. You want to hit more home runs, you got to get up to bat more. You got to get more at bats. This is how it works. If you want to get more deals in real estate, you got to show up every day for however long it takes. Stop watching the clock. In fact, choose to fall in love with the activity of showing up every day. And the results are natural. Just like the 9 to 5, if you show up and punch the clock, you'll get a check. It works just like that in real estate. It's just a little different. And most people don't trust it. But the people who do fall in love with the activity of real estate, they all get here. They all scale to this level and they get the big tax losses and all the benefits of being an owner of real estate. This is available to everyone who's interested and who gets into the game. There's just very few who are willing to go through the learning curve or to get over the different humps that are out there to make this happen. So choose to be one of the very few. You don't have to be good. You just have to be consistent. You just have to be consistent. You just have to stick with it because there are many ways to get paid. There's cash flow, there's appreciation, there's tax losses, there's debt pay down. There's 4 ways to get paid. There's a 80+% success rate for buy and hold real estate investors. It may be 80, as much as 86% success rate, whereas 9 out of 10 businesses fail. But this business, 8 out of 10 to almost 9 out of 10 succeed. It's only the quitters who lose. The problem is 90% of people are quitters. They quit everything. And real estate is not, this isn't a TV show. It's not always cute. It's not always easy. It's not always fun, but it is more rewarding than the 9 to 5, hands down. So doing stuff like this makes you better than people who are next to you. Somebody working next to you, earning the same amount of money, the same salary, keeps way less money than you because you're out doing this strategy. Even if you're not cash flowing, you're getting tax losses, you're keeping more of your check than them. When you keep more of your check and you reinvest it, you get a compounding effect, compound growth, exponential growth over the course of time. So you need only know that this stuff exists, trust it, and then march towards it. Have some directional accuracy and keep pushing yourself in that direction, and you'll start to get these types of results. Another question I'll get is like how to qualify. Who qualifies for this? In order to get the maximum benefit, I'll say you should be a real estate professional to get the max benefits of this type of a strategy. That means that you spend a good amount of time as a real estate investor, maybe over 50% of your time. If you're married, there are many married couples that work with us in the Boots on the Ground program. Typically, one spouse will do this full time. They'll become the real estate professional. The other spouse will continue to work. Maybe they're a high earner. And one person is keeping the taxes, the other person's working, paying lots of taxes. So if you have a spouse, and you can check if they're paying over $100,000, if they're having over $50,000 to $100,000 worth of taxes withheld out of their check, you can get a couple rental properties and grab that money back. A couple rentals a year, maybe just one rental property a year, and you can grab that money back. You'd be a fool not to do it. Let's say if there was a rental property that you only had to put, because we know the burst strategy, $50,000 into, or maybe you only put 20K into it at the end of the day. You took 30K, bought it, fixed it up, refinanced out. Maybe you left 20K in the deal, but it generated a $40,000 loss that you could grab back off of the taxes. It's going to reduce your taxable income. Maybe you get back 25K on taxes. So you just got a free house. How many free properties do you need, or government funded, tax refund funded properties do you need to get wealthy? And that's just a one deal a year strategy that really anybody could do with the burst strategy. So there are a few more wrinkles to qualifications. I'm going to get into qualifications on our inner circle call, which is coming up in about 5 minutes. We are going to shift there. If anybody wants to tap into our private calls, which we do Wednesday nights, you can tap in by clicking that link, or going to 247cashflowtraining.com/university, taking a $1 trial. You'll get access to everything, including our private coaching calls. So you can click there, you can tap in, become a part of the community, get connected to course content, resources, and coaching, if that's what you need to get to the next level. But we will be kind of delving deeper into this strategy. I'm sure those who are watching, who are a part of the inner circle group, are going to have some questions about this tonight. So we'll delve a little bit deeper on that call. But guys, I hope this helps you guys to understand how you can create, let me open this up a bit, big losses with just a regular buy and hold rental property strategy. You don't need to be like brilliant. You don't have to go crazy in this game. You just need to stack your chips, come in with, I probably wouldn't recommend starting today with less than 25,000. That number was a little bit lower when I started, but properties were also lower and interest rates were a little lower. But I would come in, 25K to 50K, and I would just start, acquiring rentals, leaving as little cash on the table as possible, knowing that if they're cash flowing at all, 400, 500 a month, 300. I don't like to go less than 300, but like 400, 500, 600. I like to see 500 to 800 on a single family, 1,000 or more on a multi, on like a duplex, triplex, probably 2,000 or more on a quadplex or beyond. But if it's cash flowing at all, even $200, it's appreciating, which it's likely to do if you're buying in affordable cities, and you're getting tax losses, you're winning big. So don't look at any property as just one thing, as just its cash flow, as just its appreciation potential. These properties are all things, and you need all benefits. Making money means nothing if you pay more taxes. It means absolutely nothing. It's not what you make, it's what you keep. So hope that helps. If you guys have questions, reach out. If you're interested in our Done For You programs, the Boots on the Ground program, we find, finance, rehab, tenant, and manage for you. We have our plug and play program as well. If you just need us to help you source deals and vet opportunities in your backyard and build out an operation, in California, in Texas, and wherever you're at, North Carolina, whatever market you're focused on, reach out about our plug and play program. We have a lot of support, a full staff and team that'll lean in and just help you to scale. You'll also be working with me as well on a one-on-one basis. Just reach out about any of those programs. And once again, we have the Real Estate Ride Along Tour Saturday, November 15th. If you want to come out and rock with me in person and just learn the game hands-on. Hope that helps, guys. Brian Grimes, your real estate mentor. I will see you guys on the other side. Click that link. Tap in. That link's in the description. Link should be in bio as well on IG. Tap in to the community, learn the game, and just get started before prices rise. Because once prices go up, they're not coming back down. They're just not going to come back down, guys. You're just going to miss the wave, and you'll have to buy in at a much more expensive time where it'll be a lot harder to get your hands on those 7 rentals. Brian Grimes, your real estate mentor. I'll see you guys.